In this video, I'm going to give my usual business cycle risk score update, this time for April 2020. Now, this video is going to be a little bit different than the ones I've done in the past on this topic, simply because of what I'm seeing. So when I did this a month ago, we of course were in the throes of COVID-19, had gripped the planet, markets were tanking, economic data hadn't really caught up to the point in time where we're at, which is about mid-March. Some of the data was lagging that period anyway, so I was waiting for this update to see that data had caught up to us, and the markets would probably still be reflecting that negative news. But now, here in April, markets have come back up to basically the same level they were at in June of 2019. The market, or the economic data, has caught up to where we are. But the disconnect between what the market is doing and what the economic data is showing is absolutely blowing my mind, and I just want to show you in a little bit more detail exactly what I'm seeing and why it's causing me so much consternation. I just don't get it. I have some theories, and I've shared them in a few of my past videos, but nonetheless, want to share what I'm seeing. You can believe me, agree with me, disagree with me, whatever you want. Makes no difference, but I think I just need to share exactly what I'm seeing out there. If you are new to my channel, my name is Jared Ayers. I'm a CFA charter holder. Been managing my own money for over 20 years. Done pretty well for myself, and created this channel to share with anyone who's interested the thought processes, strategies, and techniques I use to guide my way through the markets and the investing universe. So I hope you enjoy. So before we jump into the detailed analysis, I just want to highlight, as before with these updates, I have created a step-by-step video series that lays out exactly how I build up this analysis, how I get the data, what I do with it, all the calculations, all that. So I will include that video series in the description of this video. Of course, in this one I will be going into a little bit more detail where I will be overlaying the economic data, some of the key indicators specifically on top of the S&P 500, so you can see exactly what each indicator is doing relative to the market, as well as how the indicator is performing relative to both the 2008 Great Recession and also the 2000 dot-com bubble, just so you can see exactly what the indicators are doing. So I'll be pointing out exactly again what I'm seeing. So I hope you enjoy, and let's jump into the analysis without further ado. So jumping into the analysis now, here is the business cycle risk score update for April 2020, and like I mentioned, just plain ugly at 0.8. Just for those who are new to this analysis, maybe haven't seen my previous videos, I'll just quickly run through again what I do. So my 13 economic indicators are listed here. I give them a predictive power allocation, whether they're leading or lagging. That gives them a weight. Then the date of the data used is given a time weight, so more current, heavier weight. That gives me then a total weight. I look at the direction of the indicator, whether it's decreasing or whether it's increasing, and then the rate of change, whether it's accelerating, decelerating, or holding. That then gives me a score, and then I convert that to a 10-point scale. So 0 being absolutely horrible, worst ever situation, 10 being amazing, all into equities, unbelievable opportunities. And right now, of course, we're at 0.8, which is the lowest score I have seen ever since I've been calculating and watching this data. So didn't expect to show this type of score at this point. If you'd asked me 3 or 6 or 9 months ago, I would not have guessed it, but here we are. As you can see, almost all the indicators are showing decreasing, except for the ones that you don't want to show increasing, and that is jobless claims and unemployment rate. The leading economic index and the GDP growth rate are not really in line and are showing a score only because they are lagging. So going back to December 31st, 2019 on the GDP, and 1st of January 2020 on the LEI. So a bit stale with the data there, hasn't been updated, so therefore it's still registering something, but other than that, like I said, it's just ugly. We knew this was coming. saw it last month with COVID-19. At that point, the data was again lagging, so wasn't showing now. Right now here, mid-April 2020, some of the data is very current. Others are showing back at March, and so when this gets updated again, you're going to see it probably even get worse, because a lot of this isn't even reflecting April yet, which we know is even worse than March. So yeah, not sure what to say, but let's keep going here and I'll show you what else I'm seeing. So just for comparability purposes, here's March. What we saw last month, again, data was a bit lagging, hadn't caught up yet. Score was 3.6, and we knew that the consumer confidence, retail sales areas were going to come, actually they already had come down, but certainly the manufacturing PMI, non-manufacturing PMI, unemployment rate just were not showing yet what we knew was going to be coming. So here it is in all its ugliness, and yeah, now we can kind of show you exactly what's going on with each indicator relative to both the market at large and what that indicator has shown in the past. So the first one I want to share with you is the spread between the 10-year and the 2-year US Treasury bonds. So this one is important when the 10-year yield is less than the 2-year yield. It happens every so often, and usually is a leading indicator for an upcoming recession in the next 6 to 18 months. We saw that happen last summer in July, and highlighted it to myself that I was should be watching out for that coming up. And of course now here we are. It hasn't come negative again, but the 10-year yield is definitely low, and we'll see that in the next slide. So the next indicator I want to go through is the 10-year Treasury yield. So this one, of course, being a component of the spread between the 10-year and the 2-year, but the 10-year itself right now is showing a rate of less than 1%. I think it was about 2/3% yield, which is very, very low, as you can see. Part of that is probably driven by the activity by the Fed right now, buying bonds in the market, specifically treasuries. They kind of need to do that right now if they want to be able to issue new treasury bonds at depressed or low interest rates. One of the things I'm going to be watching for is the 10-year yield itself. If it starts creeping up above 2%, and if it gets close to 3%, I'm not sure the Fed's going to be able to continue buying its own bonds very, very much longer without getting the US into a pretty crazy state of hyperinflation. But I may be wrong on that one, but we'll be watching this indicator nonetheless. At the same time, of course, you can see the market has dipped and then rebounded again up to that 2019 level. So just not quite sure I understand or agree with the market activity relative to the economic indicator in this sense, but it will play out, I'm sure, in time. So just something to keep watching. Next is the Fed funds interest rate. So this one, of course, has a very distinct shape to it. Saw that the interest rate started to rise towards the end of 2015 and continued to rise up through basically summer of or early spring of 2019. And then of course the Fed started cutting interest rates again with indicators supporting that. And then of course COVID-19 hit, and here we go back down to nearly zero. Of course, look at the shape that we're seeing. It happened in 2008 and it happened in 2000. So very distinct shape. Flagged it for myself once we hit that tabletop in early summer of 2019, and I've been watching it very closely since. Again, if you look at what the market has done historically in the past when those rates have fallen, it takes a bit of time for it to start to recover. Here we are though, bouncing right off that bottom like a rocket ship, back up to 2019 levels. Again, not super sure I agree with that, but here we are, and again, something to watch. So on we go to producer inflation. So this one is usually a lead indicator that we want to be watching. Whenever inflation goes negative on the producer side, it's usually an indication that we're getting into trouble or close to getting into trouble. Saw that in 2001, 08, a little bit here in kind of the 2015-2016 time. And then a bit of a recovery, and then here we go again. Not quite there, but we know that when the economy seizes up, demand seizes up, and we get deflation, followed usually by a pretty quick and reversing turnaround into inflation. So haven't really hit, I don't think, where we should be yet here, but this often is a lead indicator for what then becomes a similar or echo response on the consumer side. So on the consumer side, inflation, CPI, again, saw a big, huge, drop and then turn around into inflation in 08. Again, a little bit into the negative in that 2015 period, and here we are in 2020, haven't quite hit that yet. Of course, we've seen oil just plummet. I'm sure as time goes on, people lose jobs, etc. That's going to be putting a lot of strain on a number of items in the CPI basket. So we'll have to see and watch that closely. Again, I think it's a little bit lagging still, the data, and this, of course, is a monthly indicator. So what you're seeing here on the market side is that the market actually came down to here, and actually this reflects the bounce already coming back up here at the end of March. So again, interesting. Again, think this is going to come a lot lower, but time will tell here as we continue down this path. Business confidence, another key indicator that's often leading and tells us kind of what the business sentiment is. This is the PMI, of course, which focuses on the manufacturing side. Whenever this one drops below 50, it means that we're probably going to be in a bit of trouble, or at least that's what the sentiment on the business side is thinking. You can see in the past when it has dropped below 50, we've been not in great shape. We've dropped now below 50 here again. We were there last summer again, but again, the markets I don't think are reflecting where this is going to end up. You can see how low we got in 2008. I think we're going to be there probably minimum to the same spot as we were in 2008, but again, that may be proven wrong, but we're going to see here as time goes on. And then on the non-manufacturing side, it usually follows the same trend. Not yet below 50, but I think it's getting there, or it's going to get there pretty quick. When people start getting laid off and losing jobs, that doesn't bode well for the services sector either, which is what this reflects. So again, that got pretty low in 08 as well. I'm just expecting this to continue to fall, and I would have expected the markets to continue to track this, but as we've seen that bounce again, just not making a ton of sense based on where the indicators are telling us we're heading. Alright, now getting into labor, so now it gets really fun. So I actually had to change the axis scale on this one, this being the actual jobless claims, continuing jobless claims in thousands. So when you see 2,000, actually means 2 million. So again, here's the peak of continuing jobless claims in the Great Recession. So just a hair under 7 million. Okay, here we are, April 16th, as I'm recording this, and we're just a hair under 12 million. Now, that should tell us something, and yet the market is rebounding as if nothing's really wrong. I cannot imagine that the number of people that have been laid off or have lost their jobs, mostly probably in the small business sector, which actually is the backbone of most economies, that those people are going to be immediately rehired once COVID-19 is under control and the US is back open for business. I just cannot see it. I could be wrong. I hope I'm wrong, but this is shocking and is also usually a lead indicator for the unemployment rate. So just take that in for a second. At the worst point in 08, 09, we got to just under 7 million. We're just under 12 million, and we reached that in, I think, 3 weeks. And this reflects data at the end of March, so it's probably even worse now. Cannot believe it, but here it is, and it's right there for us to look at. Unemployment, again, this comes after the continuing jobless claims, a spike here, as we would expect to see. Now, again, in 08, here's where we got to, okay? Around 10% unemployment before things started turning around. Okay, based on what we just saw on the continuing jobless claims, assuming that's a lead indicator for unemployment, I hope that's all we get to is 10%. But it's again pretty ugly, pretty staggering, and you can see the relationship here between unemployment and the markets, right? They go opposite. So as unemployment increases, markets decrease. That should be a confirmatory indicator, at least. It's hard to say that it really leads, but you can see at least that it confirms where we're going. And again, this is already reflecting the rebound, and this, I don't think the indicator itself isn't even close to where I think it actually is going to end up. Some of that has to do with the acuteness of this pandemic, but I have a hard time believing that all these people are going to be put back to work as soon as we're back open for business. It's just a little bit hard to digest at this stage. And then, of course, with the unemployment side comes the consumer confidence side. You can see again where we got to in 08, pretty abysmal, sub 60. This is survey based, of course. In very, very short order, we're now just a hair above 70. And people are continuing to lose jobs, which never is a good thing. And obviously consumer confidence is just plummeting along with that. I don't know that it stops where the low point was before, especially with those continuing jobless claim numbers. But I'm hopeful that it will. Not optimistic, but hopeful. So again, when employment falls, consumer confidence falls, those are huge drivers of the economy, and of course then that leads us to the next indicator in this little trio, and retail sales. So retail sales, of course, being the culmination of those other two. And I said before, when those three pillars fall, look out. You can see we're a minus 10% on a year-over-year basis for retail sales. We're already at -6 in a very short period. Now, of course, that is again due to the acuteness of this whole pandemic and the shutting down of the economy. But wow, again, markets I don't think are reflecting yet exactly what we're seeing here. So that brings us full circle back to the risk score calculation. Again, horrible score. Not seen this before. I think again the markets are not reflecting what this economic data is showing us. I believe at the root of it there is a tug of war going on between the US Fed. Well, actually I shouldn't just blame them. I mean all central banks, Bank of Canada, EU, everyone's doing the same thing. They're all trying to provide stimulus, provide liquidity, provide some sort of a safety net to their citizens, their businesses, their economies. But I think at the end of the day, I think the economy will decide where we end up. I think there's only so much debt and money printing that can actually go on for so long, and then it basically runs out. So I don't want to talk about too much about how that ends, but it's never fun. And I just hope that people are watching this carefully, not paying too much attention to headlines because they don't really paint the whole story. For me, I've always followed the data. The data doesn't usually lie, and this time I don't think it's lying either. I just think the markets are riding the backs of the stimulus that's being provided by the banks, the central banks, US Fed, etc. So in terms of how this plays out, in my previous updates I've shown how my 10-point scale translates into asset allocations. You can see, of course, now we're down towards the bottom of this, close to zero, and traditionally that would mean 0% equities, 40% bonds, 40% cash, 10% gold, 10% managed futures. Now, I have made a few modifications to this because of where we're at in the market. I don't think there's any upside in bonds whatsoever. I think the artificial demand being put on them means the only place for them to go is down. I think the commodities area and futures in general, I think, is a bit dangerous. I think there's too much uncertainty to be able to manage your way through the futures market. I think with all the money printing, I think devaluation of currencies and reduction of purchasing power is a good thing for gold, and I think that's going to do well. And so I have made a bit of a modification to this. It maybe seems a little bit dramatic, but for the state that we're in right now, I don't know where we're going to go. I don't know where we're going to end up. All I know is it's not going to end well. The economic indicators I follow, as you can see, are not painting a good picture. I would rather not be in the mix when everything starts collapsing. I'd rather just wait on the sidelines, have a bit of gold, well, quite a bit of gold, and a whole bunch of cash. So when these things finally do turn around, and they will in time, I believe, then I'll be ready with ample powder to go shopping. Not that it's going to be a fun time, but at least I should have a bit of reserves here. So anyway, that then leads us, of course, to the risk score, to asset allocation standpoint. As you can see, just a bit of history. April 2020, 0.75 is the actual score. My cash and gold allocations at this point in time. In the past, you can see where we've been. June, July last year, not too bad. August was definitely the former low point. September, October, November, December, nothing's really been above 5 except for a splash in February 2020, and then it quickly reversed here as COVID-19 hit. So, again, this isn't written in stone what I have here. Truth be told, my equity portion of my portfolio is actually, it's net zero, but I have some basically positives netted against some hedges, so that my exposure is neutralized. It's hard to fight the stimulus that we're seeing right now, so I am going to be participating in that for as long as it goes, but then the hedges I have on should step in and do their job when the economy finally wins what I think it's going to in the tug of war with the stimulus packages and the money printing. So I hope that this was helpful. You don't necessarily, of course, have to agree with me, but again, I follow the data. I don't follow the headlines. I trust the data. I don't understand why the markets are doing what they're doing fully. I have my theories. I may be wrong, but of course, everything I'm presenting in my videos is my own opinion. So feel free to leave me comments if you think the same or otherwise. I am always open. So I do hope you enjoyed that opinion of mine on where we are in the current business cycle. So I do hope you got something out of that video. Like I said, absolutely amazing what the markets are doing relative to what the economic data is showing. I think it's going to be a very, very hard downturn when it finally hits. I don't think this is sustainable. I therefore am becoming very, very, very reserved in terms of my positioning. My portfolio is getting extremely defensive, the most defensive I've ever had it, but that's simply because I see very, very little upside in the future, and I think a whole lot of downside. So I do hope everyone watching this, is packing their own parachute, so to speak, and taking what I hope is a prudent approach to investing. It's not an easy time, no matter where you are. So hopefully you're staying safe, staying healthy, and I do wish you the best. If you did like this video, please do give me a thumbs up, hit the like button. If you've not yet subscribed to my channel but want to see similar content in the future, please feel free to hit the subscribe button. And of course, if you want to leave any comments, questions, or anything else in the comment section, please feel free to do so. I love getting feedback and hearing others' opinions. So I do, again, hopefully wish you the best in the markets, in health, and in safety. And thank you very much for watching.